Hello and good afternoon, friends. Welcome to the CEC-UGC live lecture. Dear friends, as you know that we are carrying series on international trade, and in previous lecture we discussed on balance of payments and foreign exchange. We would be continuing the lecture further. We would be continuing from the point where we left, and we would be discussing more on this topic. And for this, I would like to tell you all that today we have with us in our studio once again Dr. Rajiv Shukla. Dr. Shukla is a PhD program coordinator in Indian Institute of Foreign Trade. So dear friends, if you have any queries regarding the balance of payments and foreign exchange, as we always say, that you can mail us at info.cec@nic.in. So without wasting time, I would like to hand over this particular lecture to Dr. Rajiv Shukla. First of all, I would like to welcome our guest, Dr. Rajiv Shukla. Sir, welcome to the EDICET lecture.
Thank you,
and through you, we discussed and we understood a lot about the balance of payments and foreign exchange. So I think now we should continue further.
Sure. Hello friends, yesterday we had discussed about the balance of payment scenario, about the foreign exchange rate. In today's lecture, we are going to discuss, as I said in earlier previous lecture, that we have to continue about the theory of the balance of payment and as well as foreign exchange relation. How this theory is helpful to locate the foreign exchange regulation, to locate the foreign exchange reserves, to locate the foreign exchange priorities. So first we take a theory which we discussed, which we very rarely discussed yesterday. The theory is the long run theory. As I said, there are two types of theory in the international trade scenario. One is long run theory and the short run theory. So in the long run theory of exchange rate determination, these are the theories which predominantly have to be in account the fundamental change of economy. In the short run, as you recall, the short run theory is basically pointed out the current situation of the economy. And in the other hand, if we are talking about the long run theory of exchange rate, then this type of theories predominantly take into account the fundamental changes of economy. Here fundamental changes refers, what are the fundamental changes? To the change which are going to change in the economic performance. And if you talk about the short run theory is only deal with the current situation of the economy. So here the fundamental changes refer to the change which are going to happen or which are going to see in economic scenario of the economy, purchasing power all times to come. These are the theory. There are some types of this theory. First is purchasing power parity, and purchasing power parity have also a two aspect. One is absolute purchasing power parity and the second one is relative purchasing power parity. And the third one is interest rate parity, and interest rate parity has also a two types of, one is covered interest rate and the second one is uncovered interest rate. So first we take the purchasing power parity. What is the meaning of purchasing power parity, and after get the purchasing power parity we can take a short run equilibrium. So first we take purchasing power parity theory. As you look, the founder of this theory is the Swedish economist Gustav Cassel, and he found in his study in 1918. The meaning of this theory, or you can say the basic prospect of this theory, is that according to this theory, the price levels and the changes in these price level in different countries determine the exchanges rate of these countries' currencies. So whatever the theory suggested, according to this theory, the price level and the changes in this price level in different countries determine the exchanges rate of these countries' currencies. And the basic principle, if you ask what is the basic principle of this theory, the basic principle of this theory is that the exchange rate between various currencies reflect the purchasing power of these currency. Definitely, if you can see, if the local currency of your particular country is declining or the upward move, then you can say, if your the currency is in a strong form, then you can say the purchasing power is in very appropriate form. But if the currency of the particular domestic country is in declining mode, then definitely you can say the purchasing power of the particular country is in low mode. So basically the basic principle of this theory is that the exchange rate between various currencies reflect, as the line suggested, various currency reflects purchasing power of these currencies. So purchasing power parity means the basic principle of this theory what is that the exchange rates between various currencies reflect the purchasing power of these currency, and this theory is based off law of one price. There are two types, as I said, absolute purchasing power. What is the absolute form of? The absolute form of PPP theory. So, if the law of one price were to hold good for each and every commodity, and then the theory is termed as absolute form. When one price, or you can say a PP theory, were to hold good for each and every commodity. When you take a good for each and every commodity, then the theory is termed as absolute form of PPP, and this theory describes the link between the spot exchange. We discussed earlier spot exchange rate and the price level at a particular point of time. Spot rate, what is the spot rate? Which we discussed on the same or the given period of time, on the given period of movement. Whatever was the rate decided in the given period of movement, that is called a spot exchange rate. So, this theory linkage between the spot exchange rate and the price level at a particular of time. Now, the relative form of PPP. One is the absolute form which we discussed, and now the relative form of PPP. What is the relative form of? This theory describes the link between the change in a spot exchange and in the price level over a period of time. Over a period of time. If you can recall the previous slide, then you have seen this theory describe the absolute between the spot exchange rate and price level at a particular point of time for the part of absolute form. But if you can talk about the relative form, this theory describes the link between the changes in spot exchange rate and in the price level over a period of time, not a particular time, over a period of time. And according to this theory, change in spot rates over a period of time reflect the change in the price level over the same period in the concerned economies. When you talk about the relative form of PPP, then you must know about this theory that if the changes in spot rate over a period of time then reflect the changes in the price level over the same period. It's a very basic funda. When the spot rates continue changes or continue fluctuate over a period of time, then definitely you have to see the impact of a spot rate fluctuation over the changes in the price level or whole economy. So, in the concerned economies, what we talk about, there are two types of purchasing power parity theory. One is absolute form and the second is relative form. Absolute form dealing with the linkage between the spot exchange rate and the price level over a particular time of period, and when we talk about the relative form of PPP, then we can say this theory is linkage between the spot exchange rate and the price level over a period of time. And when the fluctuation of the spot exchange rate over a period of time, then definitely it impact on the changes in the price level over the same period in the concerned economy. And this theory relaxes the assumptions of PPP, just like assumptions of transportation cost and tariffs. This theory does not include in the form of these absence of transportation cost. These are the assumption, and this theory relaxes three assumptions. So, now we have seen two types of public purchasing power parity, and one is the form is absolute and the second is relative form. And what is the difference between absolute and relative form of PPP? Now, interest rate parity theory. What is the meaning of interest rate parity theory? As we discussed, there are four types of. One is the one we discussed about the purchasing power parity. Now, the second one is interest rate parity theory. And what is the meaning of this? The process that ensures that the annualized forward premium, the process that ensures that the annualized forward premium or discount equal to the interest rate differential on equivalent securities in two currency. The process that ensure the annualized forward premium, one is forward premium, important thing here, or discount equal the interest rate differential on equivalent securities in two currency. One is international Fisher effect. What is the international Fisher effect? Is the expected rate of change. Expected rate of change is equal to interest rate of exchange rate differential. When we talk about the interest rate parity theory and what is the international Fisher effect, you can say expected rate of change. What is the expectation of the rate of change? The expected rate of change is equal to interest rate of the exchange rate differential. And the second thing, interest rate is equal to real interest expected differential rate plus inflation rate. We all know about the inflation, the thing when the value of money is below and the price of commodity is quite high. We have a we now have a very not in a very inflation mode of economy, but is near about a 5 point something the inflation rate, 5.5 something. So that's why interest rate is equal to real interest expected differential rate plus inflation rate. Combination of the real interest expected differential rate plus interest rate, we can say as interest rate. So interest rate parity theory, the definition of the interest rate parity theory is equal to the forward premium or discount equal to the interest rate differential on equivalent securities in two currency. Now the modern theory, demand and supply theory. We all heard about this theory. We all heard a couple of times about the demand and supply, which are the main factor of our market or our economy. So modern theory, the most satisfactory explanation of the determination of the rate of exchange. We are talking about the determination of the rate of exchange. All the things we are discussed which is related to the determination of rate of exchange. So the most satisfactory explanation of the determination of the rate of exchange is that a free exchange rate tends to be such as to equate the demand and supply of foreign exchange. What is the most satisfactory explanation what we talked about, which is the rate of exchange is that a free exchange rate tends to be such as to equate the demand and supply of foreign exchange, and the intersection of supply curve and the demand curves give the equilibrium price, we all know. Whatever the when we discuss about the microeconomic approach, we have seen when where the price be decided on the cut mark of the supply and the demand curve, which is the equilibrium point. We have seen in a graph also the intersection of supply curve and demand curve gives the equilibrium price, and the modern theory also called a balance payment of theory of foreign exchange. So this is the most satisfactory explanation of the exchange rate or the determination of the rate of exchange. What is called the balance of payment theory of foreign exchange. Now, as I said in previous lecture, that I will discuss about the current trend scenario in the foreign exchange reserve of India. Now, we are disclosing the trends in foreign exchange reserves in India. First, before we proceed about the trends and about the graphical presentation, we all know about the foreign exchange reserve. We discuss about the exchange rate, we discuss about the balance of payment. Why the foreign exchange reserve is very much necessary or is very much useful to our economy? Why, when the foreign exchange reserves increasing, why we said that it is a good sign of our economy? Why? What is the meaning of foreign exchange reserves? A foreign exchange reserve, strict definition, is the total of country's foreign currency. Foreign exchange reserves, strict definition, is the total of country's foreign currency deposit and bonds held by the central bank and monetary authorities. Why we call when we have a more foreign exchange reserve, then we have moved forward to grow our economy in a better direction. Everybody talks about the FDI, foreign direct investment. With the help of foreign direct investment, we can see or we can say that we have received a more and more foreign exchange reserve, and if our reserves in a more stronger form, then we can say our economy is in also on a better direction. So what is the meaning of foreign exchange reserve? Foreign exchange reserve, strict definition, is a total of a country's foreign currency, deposits and bonds held by the central bank and monetary authorities. Foreign exchange reserves, what is the foreign exchange of what is the component of, you can say, a forex reserve, are generally defined as assets held by RBI, which is our central bank, Reserve Bank of India, which is denominated in other foreign currencies. And what the foreign reserves includes? Foreign reserves includes foreign currency assets, gold, special drawing right, which we discussed earlier, SDR, and reserve positions in IMF. We separately discuss about in a very brief note what is the meaning of foreign currency assets, gold, special drawing rights. So here is the scenario, or you can say here is a definitional mode of what is the meaning of foreign exchange reserve, what is the meaning, what is the definition of the foreign exchange reserve, and what the component of the foreign exchange reserve include. In the component of foreign exchange reserve, we can see a forex assets, gold, special drawing rights, and the reserve position in IMF. So first we take foreign currency assets. What is the meaning of foreign currency assets? Are investment in foreign bonds, T-bills, deposit with foreign central banks. It is maintained in major currencies like US dollar, euro, pound, sterling, Japanese, and etc. and valued in terms of US dollar. Because in previous slides when we started this segment, I said that the forex market dealing in a US dollar, and always the deals in the US dollar. So it is a mention in major currencies like US dollar, even euro, pound, sterling, Japanese, etc. but in the value in terms of US dollar. Gold reserves are passively managed by RBI and account for around 9% of total reserves. Total gold reserves is a 9% of total reserves. SDR, which we talked about, is about the SDR form, is international reserve created by IMF, which is allocated as per the member countries' quota at IMF. So these are the scenario of the components of the forex reserve. Now the last one, reserve position in IMF, is a reserve where India can draw upon to purchase other foreign currencies from the fund. India can draw upon to purchase other foreign currency from the fund. Reserve position in IMF is a reserve where India can draw upon to purchase other foreign currency from the, most of the nations purchase the dollar in terms of gaining a more and more foreign currency. So generally preferred level of forex reserve is that country reserve should equal short term external debit, so that a country has enough reserve to resist a massive withdrawal of short term foreign capital. Basically, if you can ask, basically it may be say that the foreign exchange reserve is also very much helpful to repay our debit, our country's debit. If we have a more stronger form in forex exchange reserve, then we are in very appropriate form to pay the loan which the countries take to allocation of all the social sector services. We all know that the taxpayer of our country is in a very low form. In direct taxpayer, we have a very limited number of persons who are a direct taxpayer. But when the government allocated the fund of all the resources to our citizen, it's near our one Arab, all the peoples of one Arab, of the citizens of India. But the government has a very limited resources. So for all the allocation of funds, all the allocation of suitability, all the allocation of the you can see moreover the concern of social sector reforms, the government needs more funds, which the concerned fund does not fulfill through the direct taxes or some other resources. So government take a more debit from the other countries, from the other organizations, and this debit should be a repay, some nominal you can say a rate of interest rate, but you have to be paid, or the country have to be paid. So the foreign exchange reserve can also be a part of this repay. If you have a more foreign exchange reserve, then you can say you are in a better situation to pay your loan, or in the sense of debit of other countries. So that's why a foreign exchange reserve is also a very important feature for the country's economy. If you are more stronger in a foreign exchange reserve, then you are in a more suitable position in a world also. That's why more of the country buy a currency of the strong currency in form of US dollar. China, lots of countries buy a US dollar in the form of, after getting a currency from the local currency to buy a US dollar. Why? Because to stronger in a form of more foreign exchange reserve. Now, RBI published data on foreign exchange reserve, which we earn every week on Friday. Every Friday, RBI published data on foreign reserve. Importance of foreign reserve. We are discussing why the forex reserve is necessary or why the foreign exchange reserve is useful to our country's economy. Importance of forex reserve. What is the foreign exchange reserve? Are important indicator of ability to repay foreign debt. As I said, the foreign exchange reserve is one of the useful tool to repay our foreign debt. Because if you have a currency in a foreign form, then you are suitable to pay, then you are in a very eligible mode to pay of all the debits in a foreign form on the foreign debit. So that's why all the countries need to more stronger in a foreign exchange reserve as well as in India concerned. So foreign exchange reserve are important indicator of ability to repay foreign debt. It's used to determine credit rating of nations. As I said that this is also a sign of your credibility scenario of the particular country in World Forum. If you are more stronger foreign exchange reserve, then you are in a more better situation. As I said, you are more in a suitable situation in a World Forum. So it used to determine credit rating of nations. Can be applied to liabilities in time of crisis. Can be applied. It is also this foreign exchange reserves be applied to liabilities in times of crisis, including stabilization of funds, otherwise known as sovereign wealth funds. So these types of crises, with the help of strong foreign exchange reserve, we can overcome to these type of crises. This is the importance of foreign exchange reserves. Now, what I going to disclose the some of the data which has been collected from the secondary sources, and basically this study is the published of Journal Magazine CSO, and the period of the data is from 2002-3 to 13-14. Now the statistical analysis of trends in forex exchange reserves in India in nowadays. Here you can see ranking of country according to their foreign exchange reserve. As we discussed, it is also a sign of credit rating. It is also a sign of position in a world forum. So ranking of country according to their foreign exchange reserve. You can see over there, the first one country is the People's Republic of China, is in a very strong form of foreign exchange reserve. The second is Japan. The third is Saudi Arabia. Fourth, Russia. Now the Akil, Taiwan, Republic of China, Taiwan. The seventh is Brazil. Eighth is Republic of Korea. And Hong Kong, and then India, the 10th number of India. The scenario of ranking to the foreign exchange reserve. You can analyze the first one country, China, and this is the term of foreign exchange reserve. We touch only a 3, where the China is a group very hurriedly form or very aggressive form. So these are the ranking of the country according to their foreign exchange reserve. Now the fluctuation we can see. The total forex reserve in India year of year. You can see over here, the data is in rupee billion. In 2003, we have a 2000 rupee billion. The foreign exchange reserve in a 2002-3 is only a 2000 rupees billion. And in the year by year, it is increasing. Now, if you talk about the 13-14 scenario, Then the reserve is in a form of rupee billion, which is 1 lakh, so you can say 18,000 rupee billion, which is near about a 3 Arab something in a US dollar form. So these type of the total forex reserve in India year by year comparison. From the 2002-3 and up to 2013-14, there are continuous increasing. But if you can analyze the percentage, the growth percentage, then you can find there a very not very appropriate growth in terms of foreign exchange reserve. When from the 2007, which is near about 8,500, and then the 2008, we have crossed the 8,000 limit, and this one is a little bit a better position, but after that we have not a very enough increasing in terms of foreign exchange reserve. So you can see over there the graphs of the foreign exchange reserve, the trends of the foreign exchange reserve over the year in India. Now, the components of total reserve in India from the year of year, from the first one year is the 2002-3, in the rupee billion is 3414.76, the gold, this sign is the 3414 is the foreign currency asset. These are the components which we discussed about the facts of foreign exchange reserve, where we discuss what is the component of foreign exchange reserve include. One is forex currency assets, gold, reserve tax position and SDR, and these are the figures of the particular components from the year to year. Here you can see foreign currency assets is 3414.76 in 2002-3. Gold is 167.85 only. Reserve tranche position is 31.90 and the SDR is 0.19 and the total is 3614.70. And the upward seen you can realize here in 2008-9 and 2009-10, there is very slight increase only. The total reserve is 12838.65 and there is a decreasing 2009-10 is only a 12596.65. Is the period of, if you can recall, is the period of recession. Is the global recession occurs in 2008 and 9, and it were impact on our economy also. So that's why the foreign exchange reserve in a decreasing mode, which is 12838.65 and the 12596.65 in 2009-10, and afterward it is increasing from the 13, 2010-11, now 15, now again 12-13 is 15884.20. And in 2013-14 is a little bit smooth increasing, is the 18283.80 rupee billion. So these are the very important statistical figure which would be useful for any data interpretation, and you can also include these type of data in a research paper also. The source is RBI. Now, the component of total reserves in India, you can here green one sign for the foreign currency assets, the blue one sign for gold, is the black one sign for SDR, and the white one sign is the reserve tranche position rupee. You can identify the percentage of the total reserve in India, components of total reserve in India, percentage. Is the foreign currency asset is the highly percentage with 16609.10 is the 91%. In a total foreign exchange reserve, which one of the component who have a highly who have a high liquidity, which is called foreign currency assets, which is a 91%. The blue one is the gold, is only a 1%. The blackish is only a 1%, or the next one, reserve tranche position, is according to a 7%. So highly you can see a major part of the foreign currency assets in the total reserve in India. These are the statistical figures of the percentage form. Now the components of forex reserve year by year in a percentage form. You can see for the black one for SDR percentage, blue one for reserve tranche, blue for gold, and the currency percentage. Here you can see the percentage scenario of the every component of the particular component of the foreign exchange reserve. You can analyze the highly part of the foreign currency or the foreign assets is the green one. So here we can identify first we identify the component of the foreign exchange reserve. The secondly, we identify which one of the component covers the highly percentage in total reserves. So these are the figure indicate the percentage of the, or you can say a component of the forex reserve. Now the correlation between foreign currency assets and the reserve tranche position, the amount is total 0.61992,847. When we talked about the foreign currency assets and gold, when we correlated foreign currency and the gold, the percentage is, the amount is 0.855,837,294. When we correlate foreign currency asset and special drawing right is SDR, when we merge 761564614. In the gold and special drawing right, we have a 0.9434,80594, and we correlate the gold and reserve tranche position, then we have a figure 0.886482,694. So these are the figure. With the help of this figure, you can identify about the trends of foreign exchange reserve in India. What are the trend year by year in foreign exchange reserve in India? What are the trends of components of the foreign exchange reserves? Which one of the component is covers a major part in foreign exchange reserve, as you have seen forex assets. So these are the trends of the foreign exchange reserves in India. So in this form, we can say, we can observe from the above study that India's forex reserve has changed over the years. Definitely changed over the years. Nevertheless, the 2008-9 or the 2009-10, it were a slight decreasing. But the level of forex reserve has steadily increased from 3614 rupee billion in 2002 to 18283 rupees billion in 2014. The level of forex reserve has steadily increased. The mix ratio of gold and SDR are also increasing of the years. These are the basic conclusions which we can identify of the previous study. The mix ratio of gold and SDR are also increasing over the years. Two factors responsible for significant addition to forex reserves over the years can be attributed to the lower level of current account and deficit and high capital inflow. So these are the basic conclusion which we can identify from the side of the analysis in a graphic presentations. So the overall we can say the foreign exchange reserve in a increasing mode, either in a very slow rate or in a very appropriate, not in very appropriate rate, but even the foreign exchange reserve is increasing, which is a quite good sign for Indian economy. Now we can talk about the related to the foreign exchange reserve market. What is the main risk? Foreign exchange risk is also there dealing in the foreign exchange market. So what are these types of foreign currency exposure and risk management? How they deal with the risk, and what are the intervention of the government or from the side of company or the country? What are the risk management situations and what are the tools of the risk management? So first we can say a foreign currency exposure. What exposure means? What is the meaning of exposure? That part of company's volume of business which may get affected by movement in exchange rates, which we can see exposure means. That part of company's volume of business may get affected by movement in exchange rates. Now, the may or may not be favorable. Sometimes it may be favorable, or sometimes it may not be favorable. Then, the unpredictable. One can only forecast strong probability. How fast the exchange rate moves. What exposure exactly means? ERR is inherent in the business of all multinational enterprises as they are to make or receive payment in foreign currency. If the exchange rate fluctuation happens, then nobody can forecast whatever the concerned organization or whatever the company is going to receive in a high form or the low form, because the currency fluctuation or the currency exchange fluctuation is there. So that's why hence foreign exchange risk has become. That's why I said there is a risk. If you are dealing in a foreign exchange market, there is a risk. If you are dealing in a currency exchange market, then you can deal a particular commodity or the product in a forward step. Then you are in a situation, if you can receive in a form of better, so you can say exchange rate fluctuation in a favorable mode. But if you can receive in a lower form, then you can say exchange rate is not in favor of mine. So that's why foreign exchange rate risk has become an integral part of the management activities of any MNCs of the country. That's why we can see there are some management types of exposure. And what is the types of exposure there? First is accounting exposures. The second is transaction exposures. The third one is translation exposures. These are the types of exposure, and after that we can see operating or the economic exposure. So these are the types of exposure which we deal in the first segment of the transaction exposure. There are four exposure we have seen. One is accounting exposure, transaction exposure, translation exposure, and the operating economic exposure. Now we can deal a transaction exposure. Transaction that can have an impact on currency movement, definitely it is creating an impact. If you can transact the one commodity in the form of other country, then definitely the transaction that can have an impact on currency movement. What are the types of movements? Trade related, export will receivables, import wills payable, advance payment. These are the transaction mode, and transaction can have an impact on currency movement. And the loan repayment, repartition of investment, and after that these transaction exposure, how it generated, how it come in the form of on screen, when it is generated, and how it ends, conceived at the time of quoting a price in foreign currency, given worth when the quotation is accepted, on due date, if not met on due date, crystallized into an exposure, and the final stage extinguished when FC bought and sold. So that's why we can say a transaction exposure risk. What are the risks there? Risk in advance movement of exchange rate from the time the transaction is budgeted till the time of the exposure is extinguished by sale purchase of a foreign currency against domestic currency. So that's why we can see, if you are receiving in a commodity, if you are going to pay an import bill, then you have a risk. And what type of risk? Risk in advance movement of exchange rate. Even the exchange rate fluctuate. When the time comes when you are going to pay of import bill and the exchange rate movement, then either it is favorable or either it is not favorable. So there is a risk in adverse movement of exchange rate from the time the transaction is budgeted until the time of the exposure is extinguished by sale or purchase of a foreign currency and the foreign goods. So it will be a short term in nature and will have an impact on cash flow of a company. Now, with the help of some tools, we can manage these type of risks, and the tools is hedging. hedging transaction exposure. Most of the viewers, if you have a deal in a single economy or the one type of economy, then you must heard about this type of tool, hedging. Now the hedging transaction exposure, since exposure arises due to unanticipated movement of exchange rate entering into a financial counter transaction at a future point, its time is known as hedging. With what the hedging be done in the form of control the risk. When hedging, what is the basic objective, you can say, a formulating hedging strategy? Hedging is an attempt to reduce the losses due to unexpected or the unanticipated changes in exchange rate. Is an attempt, but hedging has associated cost. Therefore, costs are to be weighted against return and the fulfillment of the objective of maximization of value of the firm. Hedging is not only a supportive document, is the supporting tool, but hedging also has associated cost. That's why firm by nature are risk takers. Therefore, the hedging strategy is not to eliminate total risk, but to maximize the value of the firm. Simple mean, hedging is the procedure is not to eliminate total risk, but hedging is the procedure to maximize the value of firm, and until unless when the value of value of concerned firm maximize, then the risk in the firm is very low. So you can avail also a risk, and there is a risk always, but with the help of hedging tool you can maximize the value of firm. So that's why the percentage of risk is quite low. Now, if the hedging transaction exposure, if we deal in the hedging transaction exposure, the amount receivable is technically referred as long position, the amount payable is technically referred as a short position, and the MNC will have the both types of position. That's why the basic group of hedging is the payment, the payable short position in a currency in the future to be hedged with buying long position in the same currency in the forward, and receivable long position in a currency in the future is to be hedged with selling short position the same currency in the forward. And with the help of hedging you can identify the also a risk, and these are the instrument of hedging. With the help of these instruments we can apply hedging to minimize the risk. First is forward contract, second is money market hedge, the third one is future contract, the fourth is option contract, the fifth is currency invoicing, and the sixth is exposure netting, and the seventh is currency risk sharing. These instruments we will discuss in the next lecture separately, how this instrument fulfill the hedging prospects, and with the help of hedging how we can deal or how we can minimize the risk in foreign exchange market. So in today's lecture we have discussed about the fact of the foreign exchange theory, foreign exchange market reserves theory. We have deal foreign exchange exposure. We have also deal some of the tools with the help of tool of the hedging, and some of the instrument we will discuss in the next lecture, how these type of instrument can deal and can minimize the risk of foreign exchange market. Thank you very much for listening me very sincerely and carefully. Thank you.
Definitely, we would be discussing more on hedging and other aspects as well as the other instruments of hedging in our future lecture. And I would like to tell you all that if you want to access this particular lecture, you can access it with the help of the YouTube. As we daily say that we daily upload our lectures on YouTube. For you, it becomes easier to recall lecture every time, anytime, according to your convenience. And if you have any queries, you can mail us at info.cec@nic.in, so that the next time when Dr. Rajiv Shukla comes, we would love to solve your queries. Thank you, sir. Thank you so very much for giving us deep insight into this very topic. Thank you.